There's been a more than doubling in the share price of Brazilian-focused gold miner Serabi Gold this year, along the lines of pretty much the rest of the sector, but unlike many others in the peer group, Serabi aims to be debt-free by the end of 2016. Mike Hodgson is Chief Executive. He joins us now. Mike, welcome.
Hello.
Welcome back. We spoke last year when you were talking about an upward trajectory in the gold production. I know you brought on more gold mines as well within Brazil. Just update us on where we are in terms of the numbers, because you produced earnings this week which reflected that increase in productivity.
Yes, well, we followed up. I've met you a couple of times now over the years, and we went back into production in 2014. We did 18,000 ounces that year. Last year we followed that up with 33,000 ounces.
That was Palito, wasn't it?
That was Palito only, and along the way we picked up a satellite mine, a satellite company and mine called Sao Chico. So combined in 2015, our production increased to 33,000 ounces. We just missed our guidance by a couple of thousand ounces. So it was a pretty good effort. And this year we're forecasting 37,000 ounces for guidance. I'm pleased to say after 6 months of the year, we're through 20,000 ounces, and July actually has been our best production month to date. So we're well on track in Q3. So quietly optimistic we're going to exceed guidance this year and hopefully push towards 40,000 ounces. So and they're high profitable ounces. They're good margin on them. We're mining high grade gold from 2 underground mines. Mine grades 9 grams, 10 grams, mill grades 9 grams. And those ounces have a margin of something like about $350 an ounce. And you mentioned about the debt. Along the way, to sort of assist with the final sort of development of Sao Chico mine, we took out a debt last year with Sprott out of Toronto for about $8 million. That's 3/4 paid down, about $2 million left on that. It'll be gone by the end of the year. So people can do the maths. You know, 40,000 ounces with a margin of around $350 an ounce. It's a good business, a good lucrative business with these prices.
I was going to say the prices have increased dramatically since we last spoke. I want to take a look into some more detail about the cost in just a minute, because you mentioned that as all part of the mix in these numbers. Have you got any more gold coming online? Is there much in the pipe that's still yet to be produced in terms of new production? Well,
the strategy of the company was in 2012, before we revisited the idea of going back into production. We'd actually made 3 mine site discoveries at Palito, and the plan always was back then, this is pre-Sao Chico days, we were going to put a small mine into production and use positive, in the absence of equity dollars out there, we thought, okay, we'll raise our money the old-fashioned way and sort of mine gold and produce profit and fund it ourselves, organic growth. And those 3 satellites, we'd advanced to a certain point, and they kind of need a final round of drilling before we actually put them into development. One of Palito is a brownfield site, and a legacy of that mine being in production in the last decade was we actually had an oversized plant. So the idea was put in a small high-grade mine, generate some cash flow, and fund that to develop these 3 satellites, which would then hopefully add incremental production. Now those projects or those discoveries have been parked for 4 years, because basically what we've done over the last 3 years is focus on putting Palito into production. Got a little bit distracted by this kind of must-have asset Sao Chico and putting that into development. And so we're only just revisiting the exploration stroke development question right now. And as I speak, I'll be going back down the site in about 2 weeks' time. We're just starting up mine site exploration, and with a view to sort of doing geophysics and drilling out those discoveries a little bit more. And I think between the 3 of them, I would like to think, because they're only 3-4 kilometres from the existing plant, and the plant it has limited capacity and additional capacity, but it's very simple to actually add additional throughput capacity in the plant. It's just modular expansion, very cheap, $1 million if that. You know, it's just one more ball mill, a bit more flotation or cyanidation capacity. So we could bring on an additional, let's say, 10,000 ounces from any one of these satellites with an independent access, a little sort of mini satellite mine. I would say no more than $4 or $5 million per 10,000 ounces, possibly even less. So I think this is Palito I'm talking about. So I think, you know, 40,000 ounces now. I mean, this isn't going to happen overnight, but I would like to think over the next 2 years we can be talking about 50 and maybe pushing towards 60. I know those levels of production aren't exactly sort of you know, sensational, but I stress, it's spreading your cost over more ounces, and the margin just gets bigger. So
and more coming out of Sao Chico, very briefly.
Well, Sao Chico is a slightly different animal. It's definitely got more potential. We only literally started a small mine there because we didn't really have the strike extension, the exploration tenements. We now do have those. It's very much open to the east and the west and down dip. So potential there is also very good. So I think between the two, I'd be very surprised if we couldn't add ounces.
Yeah, and of course you've got a lot more cash on the balance sheet. I think you've got 5 million now, haven't you, on the balance sheet? You're able obviously to bring more cash onto this because of the rise in the price of gold. But going back to the point you were mentioning about the numbers and the increase in cost, the all-sustaining costs per ounce, it's gone up from $840 to $940 an ounce. Why?
That's actually, it's not bad practice at all, I can assure you. It's very simply the exchange rate. It's as simple as that. 80% of our costs are in reais. Now, of course, we enjoyed that at the end of last year and earlier this year when the real was 4 to $1. And in fact, we budgeted this year, it almost looks a little foolish now, we budgeted 4 reais to $1 and a gold price of 10.80. Well, in fact, everything's just gone the other way. And we're sitting with sort of 13.40 gold price and a real of 3.2. So in reality, the margin has remained the same. In fact, the margin's actually got better. But with 80% of our costs in reais, the optics are, well, your costs have gone up. Well, they have in real term, they have in terms of dollars. But in fact, if you look at our operating costs in reais, they're absolutely flat. So it really is just a shift of the real going from 4 to 3.2. So when it's expressed in dollars. So it's as simple as that. It's an exchange rate issue.
Yeah. Let's look at the share price. I mean, I said at the top about the fact that you've had this share price rise. I think it was, 2.5 pence, I think, at the beginning of this year. And here we are now sitting at, well, we're at 5.8, but it's been as high as almost 7 pence per share. Explain a bit more to investors about the perception of growth at the company and where you're going. Clearly, you just explained you want to continue to ramp up production. And if gold price remains at 1340 or plus, this is a tremendously opportunistic move for you to go into a wonderful market. Explain a bit more about the growth strategy and what you're going to return to investors.
Well, in terms of growth, we've got a resource of around 600,000-700,000 ounces between the two properties, high-grade resource, and obviously that was sufficient to get started and go and get underway. And of course, quite simply this year we've had 2 objectives: kill the debt and meet guidance and put some cash into the company. And we've done that. Well, we're doing that, and we've nearly completed that. And so, the company's in a much more robust position. So we've only really been able to sort of consider revisiting the exploration sort of question right now. So the organic growth obviously gives us our biggest bang for our buck. Here the exploration discoveries we actually have and the strike extensions at Sao Chico are right next to the plant, so it makes we can turn exploration success into production ounces extremely quickly. So that makes a lot of sense. So that's one part of it, and I do think we can have this incremental increase, which will just add better cash flow, etc. It might not address the perception of growth because we are mining small, high-grade veins, and the market tends to. Not many people understand these types of deposits. You can make a lot of money on them, but of course, one thing you cannot do. The industry has kind of got so obsessed with big, bloated, huge, enormous low-grade deposits where you've got economies of scale, but of course. I always answer back and say, well, we're throwing off a cash flow a lot of sort of 200,000 ounce producers would envy because we're mining really small, high-grade quality production. And we think that's really our niche. And in Brazil, I think there are many underground mining is not done well. And I personally think, or perhaps a little arrogantly, that we're the best underground miners in Brazil. I really do think we are. And I think there's a lot of opportunities that have been overlooked. And we've certainly been looking at a number of existing mines that are in operations, mines that are actually on care and maintenance. They've just been parked or stopped because they're 30,000, 40,000 ounces, and the big boys or other companies either can't do it, don't want to do it, and don't know how to do it. And I think we've got an opportunity with not only organic growth, but also getting some bargain M&As as well. Okay,
I'm going to ask you to step back from your CEO position, if you can, and talk dispassionately about the share price and where you think it ought to be, bearing in mind what you just said, and if we continue to see gold at 1340 an ounce. 5.8 pence a share, dispassionately, what is the company worth?
I mean, our problem, of course, is always I mean, share price is basically it's mine lifetime, it's cash flow times mine life. And our problem, we always get that truncated, but of course people, I think, discount. They say, okay, it's small high-grade mines. It's classic vein mining where you sort of have a 3-year mine life, but it rolls for like about 80 years. You know, there are many small mines like this that had 3-year mine life at the beginning, and 50 years later they're still going. And this is the problem that we always have. And you either got to have a lot of them to actually give yourself more longevity, or runway, as people tend to call it these days. So to extend that runway, I really do think we need some kind of project, or we've got to get past this perception of limited growth. I mean, I personally think, we're sitting there with resources today with sort of 7-8 year mine life, so that certainly puts the price up there in the 9-10 pence range. So that's what I feel, and I think we are sometimes a little unfairly treated by the market in that sense. But it's because people don't understand vein mining. I mean, I've been doing this for a long time, and in a number of companies. So.
Yeah, it's a small cap mentality as well, I think, for investors, isn't it? You know,
Yes.
small cap companies don't seem to go very far. Anyway, look, Mike, it's a pleasure. We've got to leave it there, but thanks for joining us, for coming in to update us on what's been happening there at the company Serabi Gold. Mike Hodgson is the Chief Executive.